Well, hello everyone and welcome to our live Q&A, and we'll do the usual format. So if you pay for a super chat, then you get pushed up to the front of the queue in terms of us answering questions. We'll just work through them in order, and Teddy's here. So yes, Teddy, you may have to do some tricks later. And thank you for joining us. And as usual, I'll ask you to like the stream, as I always do. So if you do join us and you want to help us, then please do like it and subscribe to us, because I think you'll find a lot of our content helpful. At least we try to make it that way. So let's get started. Good evening, everyone. So nice to see you, Sir Miss. Good to see you again. Paul Stitzen, hi. Rouge Shah again, great. Alain's with us, great. Thank you for all your help, Alain, and thank you for also for your comments on how to stream to multiple channels. I think we're not going to try that this time, but I did look at the videos you sent. Interesting. Hi, Julian. So the first question I think actually is from Julian, so we'll start with his question. Julian says, do you think the monetary policies employed currently are sustainable, and what are the negative implications of the high debt levels? How do we best respond to the negative effects? Okay, so I have read Stephanie Kelton's book recently, so I have got a kind of MMT mindset. So I think her point is actually a valid one, and so is the MMT point, which is if you do have complete sovereignty over your currency, then you can just print more money, and you can have very high debt to GDP ratios without a massive negative effect on your economy if you're a developed market. Now, if you live in the ECB, if you live in the Eurozone, where the ECB is your central bank, the European Central Bank, then obviously you don't have control over the creation of your own money. You only have it indirectly via the European Central Bank. So they don't have such sovereignty as the UK or Japan or the US, for example. But I think in countries where there is the ability to print your own money, in developed markets at least, then I think the narrative is changing. It's very clear that the narrative's changing, that even people who wrote, who are the kind of architects of austerity, so this book, which is on my shelf here, it's a really great book, actually. This is This Time Is Different by Reinhardt and Rogoff, and I saw that Carmen Reinhardt has recently come out and said, okay, this is a massive crisis, and what we should do is pay for things and then worry about how we're going to pay the debt back later. And I think that's the narrative which is very much the case across the developed world. We'll do whatever it takes in order to stop a complete disaster in the economy, in order to keep people employed, in order to keep people able to pay their rent and to eat, and then we'll think about how to pay for it later. And really, everyone has become an MMTer because this is widely accepted. So the question is whether that's going to continue once the crisis passes, which all crises do. But I don't think it's the case that, with debt to GDP at around 100% in the UK, maybe a little bit more than 100% in the US, there's not cause for concern, at least not at this point. What would be a cause for concern is if the GDP growth that we get, is affected for a long period of time. So if this takes a big chunk out of GDP growth for, say, 5 years, that would be a really big deal. Because if that's the case, if you have low economic activity, then our debt could grow more rapidly than our economies are growing, in which case the debt to GDP ratio also increases and the ability to service that debt decreases. So that's the worry, that we're going to see a long-term structural damage to the economy as a result of coronavirus. I think that's my biggest worry. And if that does happen, then yeah, you start to think about, well, can these people repay the debt? But will there be a default in developed markets? I think that's extremely unlikely. The places I am more concerned about a default would be in emerging markets. So for example, just to take a random example, in emerging markets in Turkey, Turkey's issued a lot of corporate debt. Some of it's hard currency, some of it's dollar denominated, some of it's in Turkish lira, some of it's local currency, and there's government debt as well. But the corporate debt's considerable. And there you do start to think, well, if there is a slowdown in activity, then will this debt be able to be serviced? And could this trigger outflow from the Turkish lira? Could it trigger even a default in Turkey, in Turkish debt? I think that's a risk. So I'm more concerned about emerging markets and countries which have less ability to service the debt. That's my worry. Okay, so let's, in terms of the negative effects, well, we've just got to hope that we can grow our way out of the debt. And, we are doing our best to do that, to try and get the economy going again. People are very aware of the fact that when economic activity is slowed down, we're going to have to get people back to normal as soon as possible. I think some countries have done that too soon, and they've put the dealing with the coronavirus on the back burner and just let it burn through the population. And that potentially could be worse because the impact on the health of the economy and the health of the population are related things. So that would be a concern. So, yes, let's move on. Right, next question. So do like our stream, that would be great. And yeah, I guess you can also share it on social media. You could tweet, you could say, oh, there's a great live stream on YouTube, and there should be a way of sharing that via Twitter or Instagram or however you do it. That'd be great if you could do that. Right. Rushar. Hi, Ramin. I hope you had a pleasant week so far. Yes, it's been marvellous. You mentioned in earlier live Q&As that you see a risk with increasing defaults. Is this still the case? Yeah. Yeah, I still think that's an issue. And in fact, I can show you what I mean. Let me just pull up the appropriate numbers in Fred, which is a really good source of this kind of information because it's US data that we're interested in. And what I'm going to look up is the C&I loan tightening. Let me just share my screen now. Okay, and I'll appear in the bottom left. There we go. So this is Fred's data for the number of banks, or the percentage of banks in the US which are tightening their industrial loan credit criteria. So in other words, when this graph goes upwards, that suggests that banks are becoming more restrictive in terms of who they give credit to. And if it goes down, then they get less restrictive. And what you can see is that recently it's gone up to levels that it was last at in the global financial crisis. So credit conditions have definitely tightened. And if we look at the effect on the equity market, that generally is quite negative. And a second thing that happens when credit conditions tighten is that default rates increase. So that would be defaults on credit cards, on home loans, on business loans, and corporate bonds. So all of those, to some extent, are part of the same economic picture, which means less revenue, and that means that more companies are going to default, more households are going to default, and yeah, I still think that's going to be an issue. It usually happens with a delay. That's why we haven't seen it happen immediately, but notice that we've only really had 2 quarters, 1, 2, of tightening conditions. And usually there's a delay before the default rates start to pick up. And usually it also has a negative effect on the equity market. So that's another thing to consider. Because obviously the equity market in the US is slightly up on the year. It's not great, but it's up slightly. But, that is a concern. So yes, I'm still concerned about it, and I still think that's an issue. So I think people should be aware of that. Anyway, it's worth monitoring that. It's freely available, and it comes out quarterly, that data. And also, if you look at the SLOOS survey, the Senior Loan Officers Survey, which that comes from, it's a great survey because they actually quote from the people that were responding to their survey, to the banks which have responded to their survey. And you can really get a nice picture of what's going on the ground for these banks which loan money to companies. So the colour that you get from that, it's really valuable. So it's definitely worth a read. Print it out, put it in your toilet, and peruse it at your leisure. Right. Jose Gomez says, good evening. Good evening, Jose. Barry says, hi, Ramon. I'm Ramin. Great content and relatively new. What do you think will happen to the housing market in the UK? Right, so it's interesting because I was looking at the nationwide survey with a client yesterday because he was in the situation where he was thinking about buying a flat in London or up north, and he was looking at the yield on that versus investing in the equity market. So whenever you do that, consider how much you'll make in the housing market versus the equity market, because long term, the equity market usually has higher returns than the housing market. That's true in the UK, it's true in the US, it's true in Australia, Canada. It's generally true everywhere. So if you do want to invest for profit, then buy to let isn't necessarily going to give you the best returns. Also, you have to consider the risk of leverage. I mean, leverage is a double-edged sword because leverage increases your return for buy-to-let properties, but it can also multiply your losses. So if we do have a period when house prices are falling, then you could be left up in a situation with negative equity and multiplied losses, where you could actually end up owing more than you've invested. I mean, usually these don't last very long. 5%, maybe 10% peak to trough is what we've seen in the past in the UK. But remember that this isn't just a financial crisis. This is a real grassroots crisis because it affects all of society, and particularly young people, because they're the ones who tend to be in client-facing service jobs, which have been very hard hit. So my concern is that weak growth in the UK is going to affect the housing market. All that we can really say is that there's still demand for property, and we have seen pent-up demand drive prices higher. We've also seen the stamp duty reduction, which is one of the government policies. We've seen people bring forward their purchases in order to avoid stamp duty, and that's been a positive. Interest rates are likely to be low for a long time, which is a positive. If it's cheap to borrow, then that tends to push prices up more. But banks are being more restrictive in their credit. We've already seen that in the US. We see the same thing in the UK. The Bank of England's talked about it. So if people are finding it more difficult to get mortgages, that's a problem, and that's a negative. There's still big demand for housing in the UK and very little supply, which is a good dynamic. That tends to push prices up. But I think growth is the biggie, growth and wage growth, because in terms of wages, we're still where we were before the global financial crisis. We've had no real wage growth on average in the UK for at least a decade. And for the average person, that means that most house prices are now quite a long way out of reach in the south. In the north, it's not so bad. So, altogether, I think it doesn't paint a great picture because the house price to rental or house price to income ratios are still very high. And again, that tends to paint a negative picture in the following decade after you have a period when house price to income ratios are high. So, yeah, I think there's a problem in the housing market in the UK. I'd much rather have a liquid investment, which I can diversify, than a very illiquid, large investment, where I can't diversify away from the UK. But if you're contrarian, maybe you think this is an opportunity. Personally, I don't think that's an opportunity. Right. Patron. Yes. So Patreon. If you do want to join our community, there are lots of goodies. It's really good fun. And you get to join us on Slack. You can ask questions of me and other members of the community. They're all very helpful. In fact, I'd say collectively, the community, and there are over 400 people who are on Slack, are more helpful than I am, because they are always looking at the Slack channel. They're always there to help you and other people. And it's just $10 a month, or now £8.50, because you can pay in pounds at last. Patrons admitted that there are other countries out there which have different currencies, so you can pay in sterling. Or euros, yes. So for people who are watching this in Europe, you can pay in euros too. And I think every 6 months or so they change the numbers. So I'm going to have to keep an eye on what it costs. But yeah, £8.50 or $10 if you're in the US. And you get to join us on Slack. You get access to our growing library of content, which is Patreon only. And you get to ask the questions which I answer in that library. So by definition, it's stuff that people find interesting. So yeah, do join us on Patreon. That would be great. Like this stream, share it via social media. That would be great. Give us a thumbs up. And yeah, time for a swig of my branded drink. Very good. Oh, and we've got a super chat from Chestad. Hi, nice to see you again. What's your opinion on the energy sector? Seems to have been beaten down and has opportunities for a recovery. Again, I can feel a screen share coming on. Let me just get the latest earnings insight for you. Right, so there'll be another one that comes out tomorrow from FactSet, but let me just share this with you. Yeah, so this is FactSet's. Let me scroll to the top so you can see the name of the publication. This is the Earnings Insight publication written by John Butters. It comes out every Friday, and this is the one from last Friday. And what I'd like to show you is the sector by sector revenue growth, because that's kind of interesting, and it shows what's going on with energy. Of course, this is backward looking. Let me just back this down here. Yeah, here we go. So this is earnings growth by sector, and this is pretty much based on forecast, because we're only about 10% of the way through Q3 earnings at the moment. So a lot of this is based on broker forecasts. This is the year-on-year growth in sector by sector earnings. And you can see which one's worst. It's energy, which is down a huge percentage for this year, down by 121%. So you can see the effect of the oil price fall on that sector. Now, is it worthwhile being contrarian? Is what I guess you're asking. And I mean, personally, I think that, it still remains the case that activity is not recovering to where it was before the pandemic. And the pandemic seems to be going on longer than we expected. There's still no sign of an end to it, in the sense that, it's burnt its way through the population. We have herd immunity, or that there's a vaccine which is very effective, or a drug treatment which is very, very effective. And while that remains the case, activity will remain weak, demand will remain weak for oil, and it's unlikely to improve until we see some kind of turnaround in either one of those situations. So, personally, I still think it's too early to get back into energy. But, I mean, I guess this is a kind of sector which is in structural decline anyway, because as people move away from oil and gas towards things like renewable energy, then obviously this is an industry which is in decline. That doesn't necessarily mean the returns will be bad. I mean, the tobacco industry is one example, which is of an industry which has been in decline for a long time, but was a great way to invest if you didn't worry about selling an addictive substance which is going to cause cancer, which many people do worry about. And similarly for energy, many people have ethical problems with investing in the oil sector or the oil and gas sector. But I think, if you are a contrarian, yeah, maybe this is an opportunity, but I'd really like to see the earnings start to improve a little bit before I got back in. And I'd like to see evidence that the oil price has increased significantly before getting back in, because it usually affects the earnings of oil companies with a lag. So yeah, maybe now is too soon. That's just my opinion. If you're a bit braver than me, obviously I'm quite old and quite a scaredy cat, so the grey hair makes me quite cautious. But perhaps you are bolder than I am. Not balder, but bolder. B-O-L-D-E-R. But you're certainly right, it has been badly beaten down. Right, next. George. Vanguard's FTSE All World yield is 1.5%. Do withholding taxes affect gains? Is there an argument for equity allocation between UK shares for income, dividends, and international ETFs for growth, capital gain? It's probably best to have a holistic view towards gains. So dividends are just one way to get paid if you own equity. The other way is through capital gain, obviously. You can't usually have a lot of both, because if a company is making profit, the board has to decide what to do with it. Do they reinvest it into projects which have a high return on equity, which gives you a capital gain, or do they hand it back to you, which is a sign that perhaps they can't think of a high return on equity project, so they think, oh fine, we'll just give it back to our shareholders, or they can now buy back their shares, which is another way effectively you can get a capital gain by undiluting the shares. So probably have that kind of mindset. Don't just look at the yield. Think about what could happen with the capital gain. Because you can always sell a proportion of your fund. You don't necessarily have to have a fund where you don't touch the capital. And it's very easy to do, and now it's very cheap to trade. So probably it's best to think about total return rather than just dividend. But your point about withholding tax is an interesting one. Now, usually for the UK, the withholding tax does affect US dividends, but it is complicated. And if you own US funds, you have to consider the withholding tax when you buy those stocks. And I know some of the pension crafters do that, and they have to fill out a W8BEN form, but they still end up paying some tax for their US equity holdings, for example. So it certainly does affect capital gain. But if you do hold it inside an ISA, then effectively you never see the capital gain, which you lose through withholding taxes. So yeah, it does get affected if it is a foreign dividend generator. But the good thing is the UK equity market's a very generous dividend payer. That's one thing it's got going for it. It's small, it's cheap, and it pays a lot of dividends. Unfortunately, it's also exposed to the UK economy, which is not great compared to other developed markets. So yeah, 1.5% isn't great, let's face it, in terms of yield. If you are willing to take a bit more risk, and here I'm talking about fixed income, if you go for something like high yield credit, you'll get about 4 or 5% yield. If you go for emerging market local currency or hard currency debt, again, you can get between 4 and 5% for that. But there you're taking sovereign credit risk. For the junk bonds, you're taking dodgy company credit risk. So as always in investment, you have to balance the risk and return, and there's no riskless return. So yeah, those are the kind of options that you've got available to you, but that's all affected by the withholding tax if it's foreign generated income. Okay, next question. Yes, and as Elaine says, I do have a video called Will the Housing Market Crash? Property Market 2020. Thank you, Elaine. Hisham Daoudi Salom says, at my age, I should be on an 80-20 equity bond allocation. Okay, I agree. I guess you're young then. However, would it be sensible to keep a 60-40 allocation until the price to earnings for global developed equity lowers again? Or is that market timing? Well, many of you will have noticed that with my portfolio, that's exactly what I do. If equity multiples are very high, I tend to sell my equity. And if they're very low, you haven't seen this yet, but if they're very low, I'll probably buy equity. So is it timing the market? Kind of, yeah. So most people shouldn't do what I do. And that's why at every time I talk about my videos, about my own portfolio, I always say don't do what I do, because for most people it's not appropriate. But people beg for me to say what I do with my money. And it's kind of like a revealed preference. You can talk about what your beliefs are, but when it comes to investing, what you actually do tells people what you really think, which is why I do it, right? That's why I show my own portfolio. So I am very cautious, I'm quite old, and I don't like to take a lot of risk. So currently my portfolio is 20% equity, 80% bonds. But for you, yeah, for most people, it's not worth doing this kind of valuation-based investment. For most people, you just keep drip feeding in as much as you can into an allocation you're happy with. If that's 80% equity, then that's what you do, and just ignore it. Don't watch these YouTubes. I shouldn't be saying that on a live YouTube, but ignore me, ignore the news, just get on with your life. Live a good life, enjoy it, and you'll probably end up with a good outcome as long as you keep your fees low and you diversify. So maybe you can get 10% extra by investing in slightly more speculative things, but you could also make a loss by doing that. So for most people, just keep it simple, keep your fees low. But it is market timing, yeah. Randeep, hello. You say, with the IMF attempting to curb devaluations of currency, would they not see MMT as just a way to do that and to try to discourage this? Well, I mean, I think this new Bretton Woods thing, if you haven't read up about that, it's kind of interesting if you Google it, IMF Bretton Woods. I mean, what they're trying to avoid is competitive devaluation, which really would be awful. This kind of beggar thy neighbor policy whereby, let's say you're an exporter like China or Japan or the US, you try and devalue your currency. There are various ways you can do that. The best way to do it is to lower your interest rate more than your trading partners. The reason why I say that is because when the central bank tries to intervene by buying lots of currency or selling lots of currency, it's usually short-lived, and they can never turn around a long-term trend. So, for example, if you're trying to shore up your currency by buying it, you have to buy huge amounts, and you have to keep on buying in order to do that. And it's kind of like King Canute, trying to hold the sea back. It just doesn't work. So I think trying to devalue a currency, the best way to do it is to have a lower interest rate, because it's interest rate differentials which drive long-term currency value. And the difficulty at the moment is that everybody has zero rates. So, to compare with the ECB, you'd have to go even more negative than the ECB. And a lot of central banks don't want to do that. But I think what the IMF is trying to do is just stop that happening, which is good, because we all should pull together as a global society in order to overcome what is a global problem. And, you know, MMT is one way to do that. So greater fiscal stimulus. Central banks can't do it on their own. You ask any central banker, they're going to tell you that they can't lend money to people who can't pay it back. Whereas fiscal policy can give money to people as in the form of grants. So that's why fiscal policy is particularly suited to this kind of crisis. So having some kind of coordinated fiscal policy would be good. Trying to avoid competitive devaluation would be good. And, you know, a spirit of collaboration to overcome this problem is a good thing. Whether they'll achieve it, I very much doubt. But we'll just have to see what happens. I think the US election is going to be a big part of that, because if the US is behind it, I think it'll have a lot more weight. And with the current president, I think it's unlikely that we'll see any support for that from the US administration. So we'll have to see what happens on November the 14th. But yeah, I kind of like the IMF's approach, but personally I think it's unlikely to succeed unless Biden's in the White House. Okay, next question. Yeah, do you like this, I should say.
Teddy?
And oh yes, Teddy hasn't done his thing yet, so let's see if we've got some treats. Do we have any treats for Ted? Oh, he's perked up now. He's heard the word treat. I've got a treat up here. Come on, Ted. You're going to do your thing. Come on. Come over here. You're going to stand. Oh, very good. Come back here. Oh, what a good boy. He was very good. There we go. You can see we've both had haircuts. So we're both looking very smart. We always like to be smart for the YouTube Live. So do like this stream, because you can feed Teddy and I. You know, we go very hungry if you don't. And subscribe to us and join our community. It's lots of fun and it's very helpful if you want to learn about investing. You can also get our weekly roundup. That's free, and you'll find that on pensioncraft.com/market roundup. You'll find a link in the description below the video for all of this stuff, actually, all of the stuff we offer. And if you do want to have a one-to-one with me to discuss your particular interests in investing, then you can do that via pensioncraft.com as well. Go to the learning menu and you'll find Power Hour, link to the Power Hour there. Oh, Teddy's still begging for food, poor thing. He must be hungry. Over here, Ted. You're just going to put your paws on my leg now, aren't you? Oh, okay then. He's got big eyes. It's hard to resist him. Right. So back to the questions. Teddy. Who's going to raid the desk? Who's going to raid the desk? Oh, Ted. Come on then. Shameless, that dog. Right. Next question. Julian says he's going to check out the book. This time is different. I'll tell you another really good one, actually, is this one, which is, so if you want to hear about how central banks kind of got started on collaboration, this thing's great. It's by, I can never pronounce his name, Liaquat Ahmed, and it's called Lords of Finance. But it talks about the central bankers at the turn of the last century, around the 1900s, and how they kind of collaborated to create what we have as a central banking system today. Really interesting. I think it's always interesting when you kind of read the history of how we got to where we are, and it explains so much of what's going on. So I find that very useful. Really enjoyable read. I never thought I'd enjoy that, but I did. Yes. So back to the question. Yeah, Julian says he's going to check out the book. He watched the VMMT video, really enjoyed it. Thanks for the elaborate answer. My pleasure. Elaborate answers are what I do. Clearly. Okay. Oh dear. Gosh, a lot of questions. Right. So I might skip down a little bit. Greetings from Chicago. Very good. So Matt Vichatek is from Chicago. Greetings from Chicago. Across the US, many, if not most, pension funds are underfunded. Most pension funds are underfunded. What's your opinion as to how municipalities will act if another stock market crash causes these funds to fail? Right. I mean, we've been in this boat before, right? So in 2008, 2009, we also saw equity values fall precipitously by 50% or more. And many pension funds were underwater and they didn't shut, right? So the point is that they don't fail. The difficulty is that new people coming into the fund have to effectively bail out the ones who were in it before, who already retired. So I don't think it's a case that funds will necessarily fail. It's just that they will be underfunded for some period of time, and they'll have to ask for the existing members to be helped out by new members. That's often the way. But eventually the thing to remember is that as long as the pension funds don't sell if equity markets fall, then eventually they're going to recover because equity markets will recover. We've already seen that happen very rapidly in the US. In the UK, it's more of a problem because if you are invested in just the UK market, it hasn't recovered to its pre-COVID levels. So anyone who had a UK overweight is currently probably going to be underwater. But really, I think municipalities are going to have to just hold on. And if they do, then eventually these pension funds will have funding ratios which go back to 100%, and they'll be able to pay out the liabilities. So I really wouldn't panic. Remember, this thing will pass eventually. All these crises usually are quite short-lived, and a pandemic, we saw it in 1918, we're seeing it now. We're talking about, at most a year, maybe 2 years before it becomes like a background flu. It's just that we don't have immunity to it. It's a novel coronavirus, which makes it such an issue. So, yeah, eventually things will recover, and I wouldn't panic too much about municipal pensions. Right, let's move on. Okay, so Michael says, between ETFs, UK gilts, and global aggregate bonds, the latter is less risky due to average duration. But I was wondering, does global diversification work the same with bonds as it does with equity? Yeah, it does. It does. And the reason why is because yield curves are not perfectly correlated. So, for example, if you look at the UK yield curve and the US yield curve and, say, the yield curve in Germany, the thing is it's much more complicated to look at yield curve correlation because a yield curve consists of multiple maturities. If all you're doing is comparing equity prices, they just go up and down. The yield curve shifts up and down, it tilts, it kinks, so it kind of gets curvy. So, you have all these degrees of freedom, which you have to consider. But generally, because they're not perfectly correlated, putting it in multiple currencies does diversify. So if yield goes up in one jurisdiction, one currency, it may not affect the other currencies. There is some correlation, but it's not perfect. So yes, diversification works for bonds just like it does for equity. So I think we've got a super chat from Chestad again. Thank you, Chestad. What are your thoughts on the US stock market pre-post the presidential election? Believe moderate drop beforehand and a good jump after. Hi, Teddy. Oh, somebody said hi, Ted. Have a treat. Have a treat. There you go. This one's from Chestad. You probably paid for that treat, Chestad. Very good. So I think the narrative has changed a lot over the last few months. Before these reports came out recently from Moody's and Goldman, for example, a lot of the narrative was that if Biden got into power, that would be seen as a negative for the equity market. The reason being he was going to increase taxes, and that would corporate taxes, and that would mean lower profits, lower earnings for US companies. So if that's the case, then that would be a negative for the equity market. But what Moody's has come out with is this idea of a blue sweep where Biden gets control of the Senate and the House of Representatives. And if that's the case, then if that's the case, then he can be much more active in terms of his policy, much more effective, and then not only can he loosen immigration rules, which are seen as a positive for the economy, but he can also kind of scale down the trade war, which is seen as a negative for growth. So both of those effects would be positives. The corporate tax would be negative, but overall, it doesn't really make much difference, because if Trump stays in power, then what Moody's was saying would be that you'd get continued escalation of the trade war, which would be a drag on the economy. There wouldn't be a corporate tax increase, and there would be ratcheting up of the trade conflicts. So kind of more of the same. And the two effectively cancel each other out. Equity is slightly better under Biden as a result, and according to Moody's, and Goldman came out with a fairly similar analysis. What's not such a good outcome is if you don't get a sweep. So in other words, Trump stays in power without gaining control of both houses, or Biden gets into power without gaining control of both houses. So those are the kind of two not so good outcomes, because that kind of limits what they can do in terms of passing legislation. But yeah, I think either way, the incumbent of the White House is kind of secondary, and the reason why I say that is because things such as the way that they deal with the coronavirus, how quickly we get back to normal activity, is probably much more important. And I suspect that would be better under the Biden presidency than under the Trump presidency, because his handling of the coronavirus crisis has not been very good. Starting off with not believing the science initially, and then not wearing masks, and then giving rather conflicting views about the effects of various drugs. So yeah, I think Biden would probably be more science-based, and that would probably be a better way of dealing with a crisis and keeping the coronavirus under control. So yeah, that's the coronavirus I think is more important than the president in a way. Right, let's move on. So how are we doing for time? We've got 15 minutes, and there's still time to like the stream, and subscribe to us if you're not already, and we'll move on. Jesse says hello. Oh no, before Jesse, we have Elaine. Okay, we'll move on to Jesse. Hello from Australia. Woke up at 4 a.m. just to ask you a question. Thank you, Jesse. I appreciate it. I'm sorry it's not the better time for you. My question is, should investors, particularly young investors, use leverage to maximize their returns? Well, you could do that, but there are certain problems with leveraged funds. And one of them is obviously that it could amplify your losses. Now, if you're disciplined, if you're the kind of person who would never sell if equity markets fall, then potentially having leverage isn't a problem, because you will see 50% falls quite regularly with a leveraged funds if it's leveraged equity, and if that happens, you'll just ride out the volatility. One of the things I've been tracking recently is a 60-40 portfolio, but both of the components, the treasury bit and the equity bit, are 3 times leveraged. What's interesting is that because of the fall in March being so big, of course it was 3 times as big when you consider the peak to trough fall for the leveraged fund. And as a result, that thing is almost neck and neck with the unlevered 60-40 portfolio because the equity hit was so big. So during volatile periods where the market doesn't really move either direction but just whipsaws up and down, remember that the leverage fund, because it's multiplying the daily returns, will gradually lose value. So if markets are moving sideways and there's a lot of volatility, the leverage funds will lose value. If the market's directionally trending upwards strongly, then yeah, leverage helps a lot. But the danger is that you enter one of these range-bound periods. That's probably something to watch for. But yeah, long term, maybe that's something to consider. But even if you do that, there's no kind of magic boost to returns because you are taking a greater risk. And risk adjusted, you get the same return. But yeah, leverage is one way to do it. Another way to do it is simply to invest in riskier parts of the market. So instead of treasuries, you put money into high yield credit. Instead of developed market equity, you put it into emerging equity or particular sectors. So I think there are other ways to get higher risk and higher return, but without having to go in terms of leverage, by increasing your leverage. I hope that answered your question. Chris says, I want to be exposed to the greatest return and risk as a repayment vehicle for interest-only mortgage, 10 to 20 years plus. What fund would be best? Better than 100% life strategy? Something with ×2. Yeah, I mean, this is the same question really about leverage. I'd just be very cautious about having that kind of leverage. 100% equity is usually enough for most people. So yeah, I'd be careful about the drawbacks of leverage. So Jesse says, so Jesse's kind of expanding on his question. He's talking about life cycle investing and leverage. Buying stock on margin can reduce retirement risk, by Ian Ayres and Barry Nailbuff. I haven't come across the book, but I would be careful about leverage. It certainly isn't an obviously good thing. There are drawbacks. The Real Scott says, Chris Jones says derivatives. That's another option, that you could consider. But there again, derivatives are complicated to trade, and getting an idea of what you're doing is trickier than you might think, because you've got things like time decay. You've got, it's difficult to kind of understand derivatives. So yeah, I mean, I used to teach about derivatives, so I do like them, but for most people, I think derivatives are too complex. But certainly you've got much tighter control of your risk and return if you do have some kind of derivative, like a call spread or whatever. The Real Scott says, hi from Scotland. Hello. In reality, is there anything with good fundamentals left? With Bank of England interference in the markets, so crazy. Should it even bother just buy hard assets? Well, I think the Bank of England is trying to help. So I think they are actually helping. They're not trying to interfere for interference's sake. There are markets with good fundamentals left. So, for example, the last video I published was about the UK economic crisis and which assets are still looking reasonable, and the UK market's looking very cheap. That's for a reason. The earnings in the UK have obviously suffered because we've been particularly hard hit with the pandemic, and obviously we've got Brexit coming up. But you maybe, if you're contrarian, that could be seen as a as an attractive sector. And we've already talked about the energy sector in the US and the other sectors which have been very hard hit. Small caps, value, all these things which have suffered very considerable sell-offs, several standard deviations beyond what we might expect, in which case eventually they'll probably mean revert, because these things usually do. So I think there are opportunities if you're brave enough to allocate your capital to that kind of thing. I mean, there are very few people queuing up to buy value stocks right now, whereas in fact now is probably a good time to do it. I'm not doing it because I'm too chicken, but I think certain people will probably make good returns that way. But in order to be contrarian, you have to move in the opposite direction to the herd. And, with value having sold off so badly for so many years now, people just aren't keen on investing in it. Oh yeah, so Jesse is asking a question and he's paid us. Thank you, Jesse. $5 Australian. I was more focused on using leaps and margin account. Leverage small cap value, total world. It'd be great to get a video on the life cycle investing paper. Yeah, interesting. Yeah, I guess leaps are kind of like an unfunded version of the equity itself. So I think you've got the same exposure in terms of delta. It's just kind of got implicit leverage inside the fund. And small cap value, well, that is brave. I mean, it's kind of interesting. I downloaded the Simba spreadsheet recently, and I ran a kind of evolutionary algorithm on it to see which combination of those factor funds would give me the greatest sustainable withdrawal rate. And without fail, every single one of the best portfolios was small cap value, small cap value, small cap value, because historically it's just done so well. But of course, what we're assuming is that the future will resemble the past. And the recent history, which we should ignore, we know this, is telling us that small cap value is underperforming. So if you do believe the back tests, yeah, small cap value is great. It does outperform. It has outperformed very consistently until recently, over the last 5-6 years. So yeah, maybe you've got a good idea there. But personally, I haven't got the bravery to do that. I guess you're young, you are brave, so maybe it's something to consider. But the life cycle investing paper does sound interesting. Do you think you could email me that, Jesse, just so that I've got a record afterwards? It's ramin.nakita@pensioncraft.com, or maybe make a comment or something, or maybe you could Slack me if you're in the community. But yeah, that would be great if you could do that. So I'd definitely be interested in doing that. So we've got 7 minutes, and yeah, 7 minutes to go. So let's say 3 or 4 questions to go. So do like us and do subscribe on Patreon. Join our community. It's very cheap. I've deliberately made the community very cheap so that anyone can afford it. $10 or £8.50 or the equivalent in euros. You can pay in your local currency now. Martin Boyson Hansen says, would you consider creating a Subscribe Star? I haven't heard of Subscribe Star. I would like to join your PensionCraft community, but I would like to not support Patreon since they have a very censorious past. Interesting. I can hear Laura kind of agreeing with you. We're not massive fans of Patreon, I have to say. We certainly have had issues with them. Even basic things like an affiliate program they don't have, which I find is very surprising. So yeah, we're not particularly wedded to Patreon. But the difficulty is once you're on a system, it's quite difficult to switch. But we'll certainly look into it. Subscribe Star. Yeah. Thank you for telling us about that, Morton. Bruce Wayne. Oh, I can't believe it's you. Hello. Would you say only UK government bonds is okay, or would you rather go global with bonds? I think we kind of covered that. You do get diversification going with global, and that's what I've done. I've gone for hedged US treasuries for 40% of my portfolio in case sterling strengthens versus the dollar and they lose value. And I've also got 40% of my portfolio in UK long duration government bonds. So, I do diversify my portfolio, the bond component. And I think that's worthwhile. And I've gone for maximum diversification for my equity because remember, I've got a minimum volatility fund and that's mathematically equivalent to maximum diversification, minimum volatility. So, I'd rather go global, particularly in this environment. Okay. Sunshine Jones, what a great name. Hi, Ramin. In my asset allocation, how do I calculate a blended fund? Is it seen as equity or blend? I don't know how to regard it in my asset allocation. Normally with these funds, you can decompose it into its individual funds. And if those funds have time series, you can work out what they are and also their correlation with the rest of your portfolio. But the whole point of blended funds would be something like a 60-40 life strategy, for example, or a target retirement. The whole point is that you don't need other stuff. So most of the time it's best to keep it simple if you have got multi-asset funds, which is the other name for it, a blended fund. And so you don't need to buy other stuff unless you want to put a tilt on your portfolio. So you could get, MyMap, one of the MyMap funds, MyMap 3, and buy a bit more emerging market because you like emerging markets. So that's probably why you'd have the tilt. I'm guessing that's why you do it, Sunshine. But decompose it and then you can work out its equity bond split, but also individual fund correlations. Tripty says, hello, good evening, Ramin. Grateful if you could advise if having 80% bonds could also be risky if market recovers and if bond yields increase. That is the risk. The whole risk problem for bonds, the things which can really hurt bonds, inflation, but there's not much sign of that in developed markets right now, or an equity market rally. But what's good is that when equities do rally, you don't get a massive sell-off in bonds. You get some sell-off, but not a massive sell-off. We're not talking about like a 50% fall in UK government bonds. If equities go up 20%, that just doesn't happen. But a 5% fall, a 10% fall, and with long duration, maybe more, maybe 20%. But that's the risk. If equities rally, the bonds lose value. That's the problem with a hedge. But what's great about bonds is that it's a hedge that pays you to hold it. Whereas if you buy derivatives like a put, you have to pay for the hedge. And you have to roll the hedge, so you have to pay continually. And that's a drag on your return. Okay, how are we doing? Got 2 minutes. I think we're going to get one more question. AQR wrote a paper on using Schiller Cape called Market Timing, Sin a Little. Found it was no better than a coin flip for market timing purposes. In fact, if you look at, there's another paper, and I can't remember the title, of course, for the purpose of this this call, but they talk about timing, or at least what they do is they band the Cape Schiller PE value, and then if it's very low, you buy equity. If it's very high, you have less equity in your portfolio. And they show that that actually outperforms just a buy and hold portfolio, which is in direct conflict with what you're saying from the AQR paper. So I kind of think it depends on who's doing the analysis and how they structure the analysis. I think a lot of people have a kind of agenda which may colour the actual analysis. But personally, I think that CAPE is useful, but not on its own. There's all sorts of other things which you have to consider. Other valuation measures, but also macroeconomic information about the credit market, which is so important, as we've already discussed earlier. PMIs, there's lots to consider. But certainly I think Cape Schiller is interesting. Certainly something I look at. So I think we're about there. It's 8 o'clock. Thank you all for dialing in. That's been a great call as always. I'm always amazed by the quality of the questions. They're just so good. Thank you for asking them. I'm sorry if I didn't get to your question, but remember, if you're a part of our community, then we do answer usually almost all of the questions on a Sunday evening call. So you can also have a one-to-one with me, a power hour, where I literally will answer all your questions because it's just us. And yeah, thank you all for dialing in and have a great week. And thank you for feeding me and Teddy and I. Good night.